Hi everyone, Clint Coons here with Anderson Business Advisors, and in this video we are going to discuss dealer status as it pertains to real estate investing. Okay, let's get started. All right, dealer status. What am I talking about here? Is it dealing cards in Vegas at a blackjack table? No, not at all. We're not talking about the traditional card dealers. We're not gambling. No, we're real estate investors. We're talking about a certain type of status that applies to individuals who go out there and buy property with the intent to sell. Now, see, that's the key thing here. You know, when you go out and you find a house and you pick up this house right here, and your intent is to flip the house. So if you're a flipper, okay, a flipper is a dealer because your intent in buying that property was to rehab the property, then list it for sale. Now, there's a lot of confusion that comes into play when we're talking about dealer status, and people end up really hurting themselves because they overpay in taxes because they don't appreciate this status. And here's what happens. When you buy property with the intent to sell it, not hold it long-term as an investment, those are called investors, right? Because you're going to make your money from your rental income. Flippers are making money from the equity appreciation in the property from their hard efforts, from their work. Or maybe you don't put any work into it. You just turn around and sell it right away, kind of like a wholesaler, but you're actually acquiring the property. So in those instances, what can happen to you then is if you make money off this flip, you make $30,000, that income there is considered active, right? So it's active income. And if it's active income, then not only is it subject to ordinary income tax, right? Income tax, it's also subject to employment tax, right? What is that? That's an extra 15.4% tax on that money. So figure out what your tax bracket is. Let's say you're in a 30% ordinary income tax bracket. You throw in an extra 15%. You're basically paying what? Close to 45%. It'll net out as on this $30K in income. So for every $30K you make, what you would have to do is take 45% of that money right there, which would be $13,500. That's correct. So you take $13,500, which would leave you then with $16,500 left over that you actually profited after taxes on that deal. And so this is a problem. And it actually becomes even more of a problem for real estate investors who buy property and then bring in a tenant buyer and they sell the property to them on an installment sale. So what I mean by that is you take this property and you're going to flip it. And what you end up doing is you bring in a buyer, tenant buyer, who comes in and you enter into a purchase and sale agreement with them and you sell it to them on an installment sale. So if the purchase price for this property was $120,000 and the tenant buyer came in and they offered, I took down, well, actually, before I tell you that, let's say you invested, your tax basis in the property is $70K, right? So your gain here on this deal is $50,000, right? This is how much you invested, $70,000 in the purchase of the property and the rehab of the property. This was the contract price with the tenant buyer, $120,000. So I have $50,000 gain. If I were to sell it, I brought in $120, take off my basis, what I put into it, I got $50,000 gain. Okay, now you bring in a tenant buyer and you're going to carry the paper because maybe they have damaged credit and they need a while to fix that credit, 2 years to get their credit repaired. So then they come in and cash this out. So you structure the deal as follows. Listen, you come in, you give me $10K down, and then I'll carry a note and you're going to pay me $1,500 a month, whatever, at 5.5% interest rate. So that's your deal. So you do this in November, all right? So you sold this property in November. So in November, you brought in $10,000 plus $1,500. You brought in $11,500. December, you bring in another $1,500. So we brought in a total for the year of $13K. How much income do you have for tax reporting purposes? You're probably sitting here going, well, Clint, you just gave me the answer. It's $13,000. But you know that ain't the answer. You know I was leading you down the road to set you up to save $13,000. The real number is sitting right there on the board, isn't it? It's $50,000. That is how much money you have to pay, because as a dealer, this transaction that we just started here is called an installment sale. When you're a dealer and you engage in an installment sale, you have to recognize all of the gain in the year of sale, regardless if you received it or not. So the IRS will expect me to pay taxes on $50,000 of income. You see what can happen now if you're considered to be a dealer and you're doing these deals in your own name? You're in that 30% tax bracket. So let's take 30%. Well, actually it's 45 because it's active income. Excuse me. Let's take 45 of $50,000. And what do we come up with? We come up with, what is that, 22,500, I think? 22,500. So on 50K, you're going to owe $22,500 to the IRS. How much should you actually put in your pocket? You put in $10,000 down, $1,500 in November, and $1,500 in December. You brought in $13K. You've got more taxes than you do money on this particular transaction. So you're short here $9,500 when it comes to paying Uncle Sam because of the way we entered into this deal. So when we talk about dealer status, this is what we're looking at. We're looking at an intent-based test. You bought property with the intent to sell. So you have to be careful on how you structure these deals and what you're doing so you don't fall into this trap. And I've seen it happen to so many real estate investors out there that engage in active flips, not appreciating the tax hit that is going to be coming after them later on. So what do? First thing is you don't want to be a dealer, all right? We do not want to be a dealer. Clint's never going to be a dealer. Clint's always going to be an investor. The dealer is going to be the entity I set up. I'm going to set up a corporation, a corp here. This is going to be a C corp. That is going to be my dealer. So I'm going to make sure that I have all the income. And you've seen my other videos where I talk about flipping. You're using LLCs that are owned by the corp. And we're doing that for asset protection purposes, but that's not the point. The thing is that I want all the income flowing into this company right here. So on that deal, if I made $30,000 on that flip, $30,000 is going to flow into my corporation. Now I can expense that out, get that money out to myself in ways that are non-taxable, right? See what I'm doing here? I'm staying away from dealer status, because if I get tagged as a dealer, it can affect all my other investments that I have over here that are not dealer property, but there's a potential that the IRS still looks at them because they say that's all I do, or the majority of my income comes from flipping, and they might just treat that as inventory in my hand. So I don't want that to occur. So I want to have that corporation protect me from dealer status. Then I will find ways to pull it back out. If you're looking for ways to write things off, my partner Toby Mathis, he teaches a class every other week. It's called Tax Tuesday. If you are not part of it, I strongly suggest you go to our website and join that, get on that. And he goes through multiple ways to pull monies out of your corporation. So we got $30,000 in there. You can take the money out, tax-free ways to take it out, multiple ways to take it out tax-free. Maybe you leave it in the corporation. So rather than paying 45% in tax on that 30%, you're going to pay tax at 21%, which means your taxes are going to be, what, $6,200. Remember my previous example? It was double that. It was over $13,000. Now we just cut your taxes in half. What am I going to do when my taxes are cut in half? That means I have more money to spend. If I have more money to spend, that means I can put it into more deals and make more money. So it's understanding what dealer status is and how to get around it is so critical to you if you are out there investing in real estate. Make sure you're doing that through a C corporation. Don't let that hit your 1040 and let the IRS come in and take up to 40, 50% of your profits and throw the state on top of that. Maybe at the end of the day, you're losing 60%. It happens all the time with real estate investors that don't understand the importance of dealer status and how it's going to affect them. All right, everyone, I wish you the very best with your real estate investing.